to try to finish up chapter 12, which is about self-employment income. On Wednesday, we went over a lot of preliminaries, including like different organizations, different types of business. Since we're focusing on individual tax returns in this class, we're just going to focus on the Schedule C. A lot of the similar concepts will apply to S corporations and partnerships and C corporations. Okay, so if you are self-employed, you'll report your business income expenses on a Schedule C, which is profit and loss for business. There's an example of Schedule C in the book after a few pages on page 382. Statutory employees, which are people who can take a special category of people that can take business deductions even though they're considered employees for Social Security and Medicare tax purposes. They can also use a Schedule C.
What's an example of a statutory employee? Is it to go have a job or something?
Traveling salesmen, mostly that kind of thing. Let's see. Self-employed people who are part of a partnership do not use Schedule C, and instead this partnership itself files a tax return, and the K-1 tells the partner what their share of income to report is. If you're a sole member of a limited liability company, then you will also use a Schedule C unless you've made one of these two elections to be taxed as a corporation, in 8832 to be taxed as an S corporation, or a 2553 to be taxed as a C corporation. And if you have more than one business, then you'll report income and expenses separately on separate Schedule Cs. If the businesses are pretty closely related, you could combine them to one Schedule C, but if you were like a fisherman and a transcriptionist, those have nothing to do with each other, and those would go on different Schedule Cs.
So even though you might have two different business licenses, someone might report both on a Schedule C if they're close enough, like merge it?
Yeah. If you were a fishing guide and a hunting guide, those are almost the same thing. So you might combine them onto one Schedule C. Okay, and then if you do have multiple Schedule Cs, the totals will be combined and reported on Schedule 1, line 3. Line 3 for business income or loss. Farmers also do not use Schedule C, they use Schedule F instead, which is basically very similar, except there are more categories of income, because most federal government payments for farmers, like subsidies and the like, are considered taxable income to farmers. So there's a lot of extra different types of income, and the categories are different. Like you'll have a line under Schedule F for fertilizers and lime and for seeds and things like that, which you wouldn't find on a typical non-farm tax return. And we did say that partnerships normally file a Form 1065, but if it is a qualified joint venture, this is defined as a husband and wife business, and they're filing a joint return, then instead of filing a 1065 and having the two K-1s flow back to the same tax return, they can instead elect to be taxed as a qualified joint venture, and each spouse is treated as a sole proprietor. Each spouse reports their own share of income and expenses on their own Schedule C. So that's the one exception to having to file a partnership tax return. Let's see. If you've organized your business, even if you're a husband-wife partnership, and you've organized your business as a limited liability company, even though limited liability companies or LLCs normally are ignored for tax purposes, if your husband-wife partnership is organized as a two-member LLC, you do have to file a partnership tax return. You can't just split it up on the Schedule C. Okay, statutory employees, I haven't seen many of those, so we can skip this slide. And we talked a lot about hobby versus business on Wednesday. And the main indicator of whether your activity that you're making money at is a business is whether you're in it for the money. If your primary motivation is for profit, then it's a business. If you have some other motivation, if you would continue doing this activity, even if you can't ever make a profit, then it's more likely to be a hobby. We talked about a bunch of statutory, or not statutory, but court-made tests to decide whether something is a hobby or a business. And we really only have to go over those if someone is trying to avoid the result of the presumption of profit. An activity is presumed to be carried on for a profit if it is in fact profitable for at least 3 of the 5 previous tax years. And if you've just started your business, it counts all the first 5 tax years. So if you just started your business in 2023 and you're not profitable, this 3 out of 5 rule is going to apply to 23, then that's the first year, 24, 25, 26, and 27. So you won't know if your business is actually a business or a hobby, or you won't have the presumption of profit rule to fall back on until 2027. So if you have 3 years of profit, it's assumed that you have a profit motive and it's a business. If your business is not profitable for at least 3 out of the last 5 years, it's presumed that it's not a for-profit activity and therefore not a business. So, and there's a different rule for breeding, training, and showing and racing horses. So we can see that there's been some interference by some kind of lobby there in the tax law.
Do you see a lot of horse breeding up there?
No, I haven't seen any.
Food costs too much here. Midwest, food's always cheaper.
I have seen some dog breeding and dog showing and dog racing, but no horses. And whenever the tax code or any, actually just the law in general says presumption, that means it's not always, well, there's things called rebuttable presumptions and irrebuttable presumption. This creates what's called a rebuttable presumption of profit, which means that, if you agree that yes, it's a business, or no, it's not a business, depending on whether you're profitable, then you can just go with that. But if you want to arrive at the opposite result, you have to have evidence that that it's the opposite result. So, for example, if I had a client who was in some kind of business and lost money for all of the last 5 years, then we have to gather evidence or coach them on what kind of evidence they would need in order to overcome this presumption of, in this case, of it not being a profitable activity. Which would mean we'd refer to those tests that we looked at on Wednesday about whether you run it in a business-like manner, whether you're improving your processes to make your business more profitable, whether you have solid, actionable plans to make your business more profitable, and do you actually expect to make a profit in future years? And there's also, I don't think it was actually in the guidelines, but there's also a bit of, is there significant personal recreational benefit in that activity? Like if you were running a restaurant, for example, and it lost money, people don't normally run restaurants for fun, so probably more likely to be a business even if it loses money. But if you had some sort of personal benefit, like if you were a online streamer, like if you're a gamer, yeah, well, you're also enjoying, you know, this would be what most people would consider a leisure time activity, and you're trying to make money at it. That's more likely to be a hobby in that case. Okay, so these notes on page 381 come from IRS publication 535. They also came from the website that I showed you on Wednesday. These are not exactly created by the IRS. These are tests that have been proposed and used in courts, in court challenges where the IRS and the taxpayer have wanted to come to opposite conclusions. Usually it's the IRS saying that your business, because it's not a business, you don't get to deduct all your losses. You know, you get to claim your income, but you don't get to claim your expenses. And then the taxpayer wants to say, well, you know, I'm losing money at this business, I want to be able to take that write-off.
If they just say basically it's R&D or business, is that generally a pretty easy case to be made?
No, you have to look at these factors, and you have to, like, if you're spending a lot of money on R&D, but you don't have the basic infrastructure of your business, you know, generating a profit, then the IRS is going to want to ask, well, what are you doing? Why are you not making money? And do you have plans to make your business profitable? And are those plans tested? And do you have enough experience to actually make turn a profit in this business? And it is, in general, very important to keep good books and records anytime you have a business. And the fact of the matter is a lot of our clients don't keep very good books and records, especially if their business consists of things like Uber or DoorDash, and they're expecting all of their they're expecting Uber and DoorDash to keep track of everything for them. And, or, you know, they may be a general laborer and they get 1099s, and then they have to do Schedule Cs, and they haven't kept track of any of their own supplies or their own business expenses. So record keeping is important, especially if you want to take any deductions. And we also talked about when we talked about due diligence, when earned income credit is involved. Well, in all cases, but especially when earned income credit is involved, you should be taking all the deductions you're entitled to. And if earned income credit is involved, then you basically must take all the deductions you're entitled to, because if you miss some deductions, then that may artificially inflate your income and artificially inflate your earned income credit. So we do occasionally do something called a reconstruction, where, you know, somebody, maybe their housekeeper, and they haven't kept track of any of their expenses. You know, they haven't kept their receipts or anything, and they don't even know how much money they made because they haven't kept track of that. And if you're working for individuals and not businesses, you don't get 1099s either. So it's completely on the business owner, the sole proprietor, to keep track of all of their income and expenses. So we can do something called a reconstruction, which is where we sit down for, you know, half an hour to an hour asking them questions about details of their day-to-day business, and try to figure out, using some kind of math, to figure out how much their income and expenses were for the whole year. We're not going to go into any more detail on how to do a reconstruction. That would be its own class itself. But that's basically, it can be acceptable, at least like the first year or two when we're doing someone's taxes. because while we're doing the reconstruction, we're also training our client, the business owner, on what kind of records they should be keeping. So I did have one client who was a housekeeper, and I pointed her out to, like, you can buy a receipt book at Walmart for a couple bucks and just keep track of, every time you get paid, write it down, and get the client to sign it whenever possible, even if they pay you in cash. And then you have your record of your receipts. And this client would bring in the receipt book with all their client signatures because they took my advice correctly. And then instead of having to ask, well, how many clients do you have? How many times do you go to their houses per week? How much do you charge? How many hours do you spend at each person's house? And try to figure it out for the whole year. Well, now we can just look at the book and say, oh, this is how much you made. Okay, so now we're going to go into the specifics of the Schedule C. Schedule C is a 2-page form, and it's separated into 5 parts. Well, it's 6 technically, because there's a part that doesn't have a title on it. That records your income and expenses. One thing to keep in mind is when we're talking about business expenses, that is separate from your itemized deductions. So a lot of people say, well, I haven't kept track of my business expenses because I don't take itemized deductions. Or they may say the other thing, it's like, well, I took all my business expenses and now, I want to make sure I keep track of my mortgage interest because now I'm itemizing deductions. Those are separate categories. Business-related expenses are offset directly against business income on the Schedule C. And your itemized deductions are things that are not business-related. So those are mostly personal things, like your home mortgage interest and your property taxes for real estate that is not business-related and other things like that.
So they keep that separate.
Yeah, that is separate. Some expenses that you claim on a Schedule C require other forms and schedules. So for example, if you have any depreciation to claim, then you also have to attach Form 4562. Actually, you don't have to attach it. You only attach it the first year you put any depreciable assets into service.
But if you're putting depreciable assets into service each and every year,
You would attach this every year. Mm-hmm. Any year that you put new assets into service, you include a Form 4562.
And now, is that for each asset or just for 1 year?
That would be for the whole Schedule C.
Okay.
is it the same form if you're doing a partnership?
Yeah. Mm-hmm. Yeah, and that would be attached to the partnership return.
So the 4562 is a generic form that can be used with any
Yeah.
other type of.
Yeah, the same 4562 can be attached to a Schedule C, it can be attached to a Schedule E, which is for rental, it can be attached to a Schedule F, which is for farming, it can be attached to a corporation return, a trust return, a partnership return. This is just a general form for depreciation. Another form that is often associated with Schedule C is Form 8829, which is expenses for the business use of your home. So if you use part of your home regularly and exclusively for business, you get, that means part of your home expenses, your home upkeep expenses, are treated as business expenses. And in order to do that calculation, you have to use a Form 8829.
So I've heard in the past that was like a frequent trigger for an audit, a home business deduction.
Yeah, I don't think so. I haven't seen it. I haven't actually seen a single audit that looked specifically at expenses for business use of home. So I think that's either an urban legend or maybe it's old information.
They're way more common now for people to take a home office deduction, right?
Yeah, I don't know. I don't know if it's more common than it used to be, but I have not seen the IRS audit anyone over business use of home, as long as it's reasonable. If you're saying you're using 90% of your home for business, then yeah, that's probably an audit red flag. But We don't do tax returns.
Now, could you do that for a partnership too?
No,
No.
no, because a partnership doesn't have a home. Partnership is a separate entity. What you could do instead is you could, there's two options. If you're a partner in a business and you use part of your home for business, the two options are, and you should write this down in your, I mean, I don't mean in your notes, but you should write it down in your agreement, partnership agreement, or your operating agreement, what route you're going to take. One option is that you basically use an 8829 as a worksheet and demand reimbursement from the partnership for the use of your home. So you could say, you know, business use of my home was $5,000 this year, pay up. And that would be an expense to the partnership, which would reduce your taxes, but it would also reduce the other partner's taxes. The other option is so if you are not eligible to be reimbursed, so that's going to be in your partnership agreement or operating agreement that yes, even though we're running our business out of Daniel's garage, he's not going to be reimbursed for using his garage. Then you can take this deduction, business use of home, in addition to counting your income and expenses on the partnership. So Schedule E, page 2 is where you report your partnership income or loss. And then you can put on a separate line, this is unrelated business expenses or unreimbursed business expenses. So if you have business expenses and your operating agreement says you're not eligible to be reimbursed for that, then you can just take a tax deduction for that instead.
Is that how most people go about it, as the route of unreimbursed business expenses, as opposed to like getting into it with their partners and such? Or
I say it's I think it's about 50-50. I think, especially if it's business use of home, and one partner it's one person's home, then they're usually going to be reimbursing that partner. But if it's like business use of home, but both partners have like their own home office that they're doing some work for, then they would say, you each take care of your own expenses and nobody gets reimbursed. So I would say that the slight majority goes toward the unreimbursed partner expenses for business use of home.
But the net result is effectively the same?
Yeah. Well, the net result is if you're a partnership and you get reimbursed for that, then the net result is you're sharing that deduction with the other partners because the partnership gets to deduct all the reimbursement. But overall, like in the big picture, if you look at everybody, it's the same either way.
Does that count as income for you if you get paid from the partnership for their business use of your home
No.
or garage?
No.
It's not income?
No, because you have expenses and you have an expense report that matches those expenses. So you're basically drawing up an invoice for, this is my expenses, and the business partnership pays that invoice.
Oh. What if you basically own your home and you use your main garage instead of parking your car in there, or you have a detached garage or something like that?
Mm-hmm.
So you have property taxes, but you don't have your typical, holding costs of a property.
Mm-hmm.
Would you still, it'd be pretty minimal for someone to pay just your property taxes on it. If you got paid above that, would that be basically business income, or income to you? Even though it's still your business?
Well, if you were reimbursed more than your actual business use of home expenses, that's what this worksheet is for. If you were reimbursed more than the expenses that you were claimed, then it would be income too, yes.
So with me, since I'm gonna be doing trees and firewood and stuff, I have to take a portion of my yard to store all the firewood. Would that be under this too?
Yeah. And it would be pretty minimal if it was all outdoor. So it'd just be like a percentage of your property taxes and probably, and possibly a portion of your rent. But business use of home normally is like your garage or other indoor space, and that gives you a percentage of your rent or mortgage interest and property taxes, a percentage of your utilities, percentage of your home repairs, as long as the repairs somehow benefit the business use of home area. So like remodeling your kitchen doesn't help your home office, so that wouldn't count, but.
If I build my garage and I put a power meter on it in the business name, then it just becomes a business expense, right?
Mhm.
And I don't use this.
No, you would use this,
I would.
yeah, anytime you're using part of your home for business. If it
No,
was
it wouldn't be my home, it'd be a detached garage.
right, but it would be on the same lot, so it is part of your home. It would only be considered a completely business, related piece of real estate if it was on a separate lot.
Gotcha.
Okay. And then another form that you typically have to include with your Schedule C is if you have a net profit, you also have to include Schedule SE, which calculates your self-employment tax. Okay, so here's our example of the Schedule C, and here's our basically our different sections. So here we have our background information, which is the taxpayer's name, and unlike many many tax returns or many forms that get attached to your tax return, even if you're filing jointly, this only has one name on it, and it's either going to be the taxpayer or the spouse, whoever's first or second. So if it's Bill and Jane Harvey, then this would either be Bill Harvey or Jane Harvey. So only one of them can be the proprietor. In the case of a husband-wife partnership, qualified joint venture, then you would have two Schedule Cs, and you'd have one name on each of the two Schedule Cs.
Would they be identical, like just 50-50 of
If
it?
it was 50-50, they would be basically identical, yes.
But if it was somehow considered not to be 50-50, and you just portion it out, whatever the proportion is?
Yeah.
For pretty much everything?
Yes, so I have, I've had qualified joint ventures which were 90-10 and 51-49, and those are, and it would be whatever percentages. So if there's like 100,000 in income total, then it would show 51,000 on the majority partner and 49,000 on the minority partner. But otherwise, if it's 50-50, then the two Schedule Cs would basically be identical, yes.
If they were married filing jointly but had a qualified joint venture, would there be any different net result of that, or would it be pretty much the exact same net on their income taxes?
It would be the same net, yes.
It just, the scenario of qualified joint venture would be if someone was, say, married when they started the business, but no longer, now they did separate returns that they might have to have, right?
I don't know what you mean.
I guess when you mention the qualified joint venture and splitting it up between, say, husband and wife, that makes more sense if when they started it, they were married. They got divorced, no longer married, but still operate the business together.
Yeah, if they operate the business together and they're no longer married, then they have to start filing a partnership return.
Okay.
You can only do a qualified joint venture if it's a husband and wife business, and those are the only partners, and they're not organized like as an LLC.
I guess I find it, I mean, it'd be pretty rare, right, to do one, a qualified joint venture, Schedule C?
Not rare at all, no.
Why would one want to do that? Is it just about attributing the income to one or the other so they can prove that they have income for qualifying for loans or something like that?
There would be, well, first of all, maybe they want to show one spouse has income, so for a reason like that. Another reason would be that each spouse pays their own self-employment tax also. So they would qualify for a different or possibly higher amount of Social Security when they retire, turn age 67, based on having this income. So but it would also depend on the facts and circumstances. Like if If they're both working in the partnership, or if they're both working on the business, then it's probably, they should file separate Schedule Cs.
Gotcha. Even if it goes back to the same joint tax return later.
Yes. And so the basic idea is, if you're working and making money, should have income. So if both spouses are working and making money, they should split up their income according to some measure. It could be 50-50, or they could keep track of their hours and split it up that way. But they should file separate Schedule Cs if they're both working. Another option would be one spouse could be the owner and the other spouse could be that employee of that owner. But then you'd have to go through payroll, and that's often more of a headache than it's worth if you're only going to have one or two employees. Okay, so we have the name of the proprietor and their social security number. We have your principal business or profession, including your product or service. So this is, what are you selling? And then there will be a business code. It's a 6-digit code, and there's about 100 or 120 different possibilities, and they're not summarized, I don't think, in your book. But you can get a pretty good idea. You can Google for the Schedule C instructions, and that will tell you what all those codes are. But these are based on, they're not exactly the same, but they're based on the North American Industry Classification System, or NAICS. So this is almost the same code that you would put on your business license, for example. The NAICS system has thousands of codes, whereas the tax return only has hundreds of codes, and usually they just abbreviate it. So if your NAICS code was like 141191, they would probably just put 141000, and just all the 141s go together, or something like that.
So they just group it up for what? Very broad industries.
Yeah. Then Part C is your business name. So if you don't have a separate business name, then you leave that blank. But this would be like if you're doing business as. So if it was Daniel Deal doing business as something, then you would put your business name there. And then here, you'd put your employer identification number, or EIN. And if you don't have an EIN, you just leave it blank. Do not put your social security number in there. It's often a good idea to get an EIN even if you don't plan to have employees. You're not required to. If you're a sole proprietor and you don't have employees, you're not required to have an EIN. But it's often a good idea, because if you do, then when somebody asks for your EIN or social security number, like if they hand you a W-9 because they're planning to issue a 1099, you can give them your EIN and thereby protect your social security number.
And do you have to apply to the IRS to get an EIN? You apply with the IRS for the EIN?
Yeah, and then that is, it's really a 5-minute process. You just go to irs.gov, or you Google for EINs. Make sure you go to the IRS link, because if you Google for EINs,
Plus, you actually need it to get open a bank account.
yes, and that's another reason to have EINs, because most banks will not open a business account without an EIN. Okay, so if I just Google for EIN, fortunately this time our first result is irs.gov, but if we scroll down, there's going to be third-party providers that will charge you. Some of these will be ads, and some people will charge a fee to apply for an EIN, whereas it's completely free if you go straight to the IRS website.
And do you need a business license to get the EIN?
No, once again, remember the IRS does not
That's
care whether you're abiding by state law or not. Okay, and then business address. This will often often be the same as your own address, but it doesn't have to be if you have a separate business location. And then we have a section for accounting method, cash, accrual, or other. 99% of our clients are going to be on the cash accounting method. And what that means is you count income when you get paid, and you count expenses when you pay them. And that is the intuitive way that most people think of, of income and expenses. The accrual method is a little bit more complex, and that is something you might learn in an accounting class or a bookkeeping class if you ever took one. But accrual method is basically you count income when you earn it, and you count expenses when they become due, regardless of whether you get paid on time or not, or whether you paid your bills on time or not.
That's mostly like publicly traded companies and larger corporations that use it, right?
Yes, yeah. Accrual method, accountants consider that more accurate because of things like the matching principle, like your expenses that you're paid are producing the income that you're earning. And if you if you do a project that takes 6 months and you don't get paid till the end of the project, you're still making money, you just haven't gotten paid yet. So it basically balances it out or spreads it out over the 6 months you're working. So accrual method is considered more accurate by accountants, but anybody who is on the accrual method probably has their own in-house bookkeeper or CPA that's not necessarily doing their taxes, but at least preparing their financial statements for them. And yes, as Dimitri said, publicly traded companies and any company, I believe the threshold is $50 million. Any company that has revenues of over $50 million must use the accrual method. It's either 50 or 5, it's one of those two.
Yeah, but at $5 million, you can afford a bookkeeper.
Yeah.
So even larger local companies that you might think are pretty big, they may still end up using the cash basis because it's simpler and they're below the threshold?
Yeah. Yeah, let me double check that because I really feel like that's something I should know, so I want to make sure I get it right. I'm not finding it. But yeah, we do have small companies that, that are in the million or a couple million in revenue that still use the cash method.
But you've seen people like your biggest clients here, that they pretty much all still use the cash basis?
Yeah. Okay. The next few questions are: do you materially participate in your business? That is, if you're like a silent owner and you let the business run itself and you don't perform any work in it, then that would be passive activity. But most people, almost all of our clients, yes, they do work in their business. Then there's a checkbox for if you started this business during the current tax year. And then the next two are about 1099s. Did you make any payments that would require you to file Form 1099? There's yes or no. And then the next question is, if you said yes to the previous question, did you actually file those 1099s or do you plan to? So you don't want to say yes, I'm required to, but no, I'm not going to file them. There's questions like that that are like basically like perjury traps. Like if you put yes and yes, and then you don't file your 1099, not only are you guilty of not filing required returns, but you're guilty of lying on your taxes too.
And you would use a 1099 for like a contractor or something?
Yeah.
Self-employed?
So remember, 1099 is required if you pay any individual or partnership. So any payee that's not a corporation, 600 or more in the course of your business. Yeah, those are the three requirements.
So if there's three of us in a partnership, I don't have to give them 1099s?
No, you don't pay right, that's all part of the same business, so you wouldn't give 1099s to each other.
We just figure it up on taxes.
Mm-hmm. Yeah, so 1099 is required if you pay 600 or more to a non-corporation to somebody who's not a corporation in the course of your business so that means if you pay someone 600 or more for a non-business reason, so if you pay your lawn guy $20 a week and for 30 weeks, that's $600. You don't have to issue a 1099 if that's not a business property that they're taking care of. So in the course of business, for services. So those are four requirements for your requirement to file a 1099. So 600 or more, someone who's not a corporation in the course of your business for services rendered, which means not goods. So if you're buying lumber or equipment from somebody, you don't have to give them a 1099. So when you buy your truck for your business, you don't pay a 1099. But if you pay a mechanic to fix your truck, then that would be a 1099 situation.
Unless it was a business or like a
Yeah,
shop.
if they were a corporation, yeah.
But then again, any business that, takes a car into an automotive shop, they're not planning on, because they're a business of some sort, even though they don't know their classification or if it's a sole proprietor.
Well, you need to know their classification, because if they were a corporation, if they were not a corporation, you still have to issue a 1099.
I mean, like a business that takes their car engine to get it rebuilt at some other automotive shop, right?
Mm-hmm.
And there's employees and stuff like. And generally, it's not on their radar to be giving them a 1099 when they pay them for the work because they got the receipt and such, right? I mean, at least generally that's how it is. Is that incorrect?
It is incorrect, because if you pay someone that's not a corporation for services that they provide, then you issue a 1099.
Even if it's a business to business.
That's literally the only time you issue a 1099 is when it's business to business.
I guess, my family ran an automotive shop for years. I don't think, no matter what business people we had, I don't think we ever got a 1099 from them. I think everybody just assumes if they have a receipt, they don't think beyond that.
Yeah, well, then that's incorrect. They should have been getting 1099s unless they were incorporated.
Huh.
So Midas, I just pay cash, but the guy that's got the shop at the end of my road, I'd have to give him a 1099.
Yeah, you should give them a W-9 first for them to fill out, and if they check the box that they're incorporated, then you don't have to worry about issuing a 1099. You just keep that W-9 on file that says, yeah, they're a corporation, no 1099 required. But if they were a partnership or sole proprietorship, then yes, you would have to issue a 1099.
Even if your local shop's similar to Midas, as a sole proprietor with like 10 employees or whatever, businesses should really still be giving them 1099s?
Yes, businesses issue, that's the only time 1099s are relevant. Businesses issue each other 1099s. So anytime your business pays another business, you issue a 1099 for services rendered, not goods or equipment or anything else.
What about the scenario of like, auto repair bill, which is usually a combination of goods and services, like parts and supplies and labor, everything. Is that, if there's any level of goods in it, is that a point at which you don't need to, because it's a hybrid combo?
No, then in that case, you would still issue the 1099.
Okay.
So yeah, I mean, it turns out a lot of people don't know the rules, but yes, you would issue a 1099 if you had, if you were a general contractor and you hired a paving contractor, and you should issue a 1099 to the paving contractor unless they were a corporation.
Gotcha.
So this is not, a lot of people think of 1099s as like just something you give to like laborers or something like that, but no, it's any business that you pay in the course of your own business. Okay, the next section is for income, and this is, there's 7 lines here because there's some calculation sometimes that has to be involved. There's a line for how much money did you make, what were your gross receipts or sales. And technically, although sometimes we report it the other way, but technically any sales tax that you collect is not part of your gross receipts. So we're no longer in city limits, so we don't collect sales tax, but last year we were, and it was 2.5%. So if I bill you $200 to do your tax return, I actually collect $205, but I still only count $200 as a part of my gross receipts, because that $5 at 2.5% is not my money. And I'm not supposed to put it in my pocket. I'm supposed to give it to the city of Wasilla. I'm just holding it for them. It's not my money.
Do you know on sales tax scenarios, like, because for example, it costs like 3% to process credit cards, right? And everyone's paying with the credit card. A business that collects, their receipts and charges sales tax, I'm guessing the city of Wasilla probably doesn't give them a credit for those processing fees. The business just kind of eats that on behalf of their customers for the benefit of the government.
Yeah.
Is that right? Or you haven't seen that there is a
There is, if you file your, at least in Wasilla, I don't remember how it's like in Palmer, but in Wasilla, if you file your tax return on time, which is due every month, you file your monthly sales tax return on time and you pay on time, you get a credit of 2.5% of the sales tax you collected. So if I had 10,000 in sales in the month of October, and I collected $250 in sales tax, then as long as I file my October return on time, then I get to keep 2.5% of that 2.5%. So I only have to pay $220 or something like that.
Is that meant to offset the cost of processing?
No, I think it's just an incentive to get you to pay on time. Okay, so technically you would, but a lot of people will report when they do their bookkeeping, or if they have a bookkeeper do their bookkeeping, they'll have like this is how much money I collected, and then they'll have somewhere in their expenses, this is how much sales tax I paid. But the sales tax is technically not a business expense because it's not imposed on the business. The business doesn't pay sales tax, the customers pay the sales tax, the business just collects it on their behalf. So technically, you would subtract the sales tax from the revenue first and put the net there.
No, being out of Wasilla, do you have to pay the city sales tax?
You only have to pay city sales tax for services or goods that were purchased while in the city of Wasilla. So if you did a service for somebody in Wasilla city limits, you would have to charge their sales tax.
Gotcha.
Or if you went to, if you were selling goods, let's say candy, and you went to the Christmas Bazaar at the Menard Sports Center, actually I don't know if that's in city limits, I'm pretty sure it is.
I think so.
You have to collect Wasilla sales tax on anything you sell there. Or if you're at the fair, at the fairgrounds, that's in Palmer city limits, you have to collect Palmer sales tax while you're there. And I know specifically for the fair and some of the bazaars and shows that go on at the fairgrounds, you can apply for a, like, this week only business license. So you're just like, I'm just doing sales tax because I'm at the fair, and it's a lot cheaper than a regular annual business license. Okay, so your gross sales, the next line is your returns and allowances, and that would be a negative number, or it's not a negative number, but it would be subtracted from your gross receipts. Returns and allowances is basically refunds. And the difference between a return and allowance is if you sell something defective or something that the customer doesn't want, and they bring it back and you give them their money back, that's a return. But if you say, I don't want you to bring it back, I'll just give you a refund anyway, that's an allowance. Or maybe it's a partial refund. Maybe they ordered from you online and said, I want 4,000 green pillows, and you accidentally send them blue pillows. And they're like, well, this is not what we ordered. We say, well, would you take, if we paid you back half, would you be willing to keep them? And they say, okay, then that would be an allowance.
So, and that operates just the same as a expense, except it's just on a different area?
Yeah, because that's not considered technically an expense, it's reducing your gross income. And then we have a spot where we subtract line 2 from line 1. Then we have a spot, line 4 is where you enter your cost of goods sold. Cost of goods sold is calculated from part 3. And the cost of goods sold, your net sales minus your cost of goods sold is your gross profit. So if I were selling things that I build, and let's say I'm building furniture, so I spend $15,000 on lumber materials, and I sold $30,000. My gross profit is the $30,000 I made minus the $15,000 I spent on materials and lumber. One of the reasons it's calculated this way instead of counting that as an expense is because part of the definition, one of the legal definitions of gross income is only your gains from property dealings. So if I build a table and it costs me $2,000 to build that table and I sell it for $5,000, my income for tax purposes was $3,000. And that's, so it's this gross profit also that goes into the gross income test for purposes of, for example, if you want to see if you can be claimed as a dependent, or if you're required to file a tax return. So if this gross profit is more than your standard deduction, you have to file a tax return, even if it turns out your expenses are a lot. But
if you made like $10,000, you have a standard deduction of 13,
Mhm.
then even though you had a gross profit, you wouldn't have to file necessarily?
Right, if your gross profit was 10,000, your standard deduction is 13,000, that's less than your standard deduction, so you're not gonna owe any income tax.
But that's
So,
not counting all the other expenses though, so you may have technically a net income off your business that's even lower.
Mhm.
But if you're saying the gross profit is above your standard deduction, then that's the threshold.
Right.
So-
Also remember, way back from chapter 1, that if your self-employment income if your net is 400 or more, you're also required to file a tax return. So it is possible that I might have 10,000 in income and $9,700 in expenses. Since my gross income is less than my standard deduction and my net income is less than 400, I'm not required to file this tax return.
But you could be under the standard deduction threshold, but still have a higher net income above that 400 and still have to
Right.
technically file.
If this was 9,100 instead of 9,700, then I would have $900 net profit and I would still be required to file a tax return.
What's a Schedule C cost again in terms of?
On the low end, about $200, and it could get more expensive from there depending on how complex, like whether we have to do a lot of 4562s, 8829s, whether we have to do a lot of individual bookkeeping for you. Like if you come in and you have a bookkeeper that deals with your calculates your income and expense for you, and they produce a profit and loss that looks pretty reasonable to us, and we don't have to do any adjustments to it, then that would be a cheaper version of a Schedule C because there's less work involved. But if you come in with a bag of receipts and expect us to add it all up for you, it's going to be more expensive. So this form, and if you have employees and you have other tax credits that are business related, so typically a Schedule C could run anywhere from 200 to 500 or more, depending on the complexity and how much work we have to put into it.
And then that'd always be deductible for them in the following year, correct?
Yes.
Or it'd be deductible if it was 2022 year stuff in 23 when they deal with it, and then for 23 when they do the cash payment for it, then they'd be able to deduct it in 23.
Right. Yeah, and even if it was accrual, it'll still be deductible in 2023 because the work wasn't done for you until the year 2023. The work of preparing your taxes is being done in 2023. So whether you pay it in 2023 or not, it would be deductible on accrual method when the work was done. All right, the next section, part 2, is for expenses. And there's about 20 categories of expenses, and I like to, other tax preparers have a different philosophy, but I like to try to shoehorn people's expenses into these particular categories as much as possible. You know, if they have an expense category that simply does not fit into any of these, then those would go into part 5, other expenses, where you would list other expenses. So someone who subscribes to like a professional journal, something like that, that doesn't really fit into any of these categories. So you'd have a separate line here, maybe like dues and subscriptions with an amount.
It wouldn't go into something like office expenses, who's got a journal, magazine, or whatever?
No, because I mean, office expenses. If they subscribe to like an outdoors magazine to leave in the lobby for people in the waiting room, that would be an office expense. But if it was like a professional journal, like if you're a doctor and you subscribe to these medical journals to keep up with your profession, that could go under dues and subscriptions or education and training. Neither of those are categories on the main part of the Schedule C.
So there's the main categories, and then there's other very common broader categories that
Mhm.
it gets classified in on
Yeah.
part 5.
Yeah.
Okay.
Our business software, not our personal software, 1040, but our business software for like 1065s and 1120s, indicates like about 50 or 60 categories. So there's actually a line for janitorial, and there's a line for dues and subscription. There's a line for education and training, but this is a lot more basic in the categories that they offer.
Would people then a lot of times somehow squeeze those into the other ones? Like if it was janitorial, they put under legal and professional services?
Janitorial, I would put normally under office expense. Especially if it was just their office that they were cleaning. If they had like a large, like if, I have a client who is a Taekwondo instructor. And so he hires someone to clean the whole gym area that he rents. That would not really be an office expense anymore. But if it was a professional, like an attorney, they don't have like a huge space. It's just basically their office. So it's like an attorney, accountant, or a tax preparer. Janitorial I would put under office expense.
Okay, so for different industries, it might play a little bit different for the same type of service that someone's paying. Okay.
Yeah. Like if I were doing taxes for our own company, I would count like window cleaning as an office expense and janitorial and that kind of thing.
And it seems like a lot of these things that could almost go into one or the other, the IRS probably isn't going to care very much how it gets classified.
Not really, no. As long as you can produce the receipts and really it ends up going to the same place. It ends up going to the same bottom line. And one of the ways the IRS decides whether to audit a return is that they'll use this industry code, and they'll compare your tax return to a bunch of other Schedule Cs with the same or similar industry code, and they'll use ratios to determine, you pay 20 times as much for advertising as would be typical for someone in your line of business. So they may say, well, seems like a lot, so they may audit. Sometimes an audit will be specifically one line of your tax return. So you'll get something called an information document request saying, please provide all of your advertising receipts. And that's it, and that's the whole audit. And if you have all of the receipts, then you pass the audit, and the IRS says, okay, good, no changes, we'll move on to the next person.
In those type of audits, that's an individual initiating that, or is that a kickback out of the software, totally automated without even individual human interference?
The IRS is almost completely computer run now, because of, except for last year, every single year from 2010 through 2022, the IRS had its budget cut. Even though they're being given more and more responsibilities every year. So they automate everything, so it's all computer run. So when you respond to an IRS letter, that does get looked at or reviewed by a human at the IRS. And usually your response is the first time anybody's ever seen that tax return. So they have to go back and look at the original tax return, look at whatever the computer spit out, and then look at your response.
So that's why there might be a long delay between your response and them responding to your response?
Yeah, because, well, the other reason is because the IRS is still short-staffed, so it arrives, your envelope arrives at the IRS, and it takes about 6 months for it to actually get placed on someone's desk and say, okay, you work on this. Because it's just that much mail. There was an article, I forget, I think it was Forbes, but I forget exactly who produce this article, but they went and looked into the Ogden Processing Center. And this was at the height of the COVID thing. So it was that summer of 2020, and you know, the employee cafeteria was no longer a cafeteria, it was a paper return storage facility. So if you're an IRS employee, and it's a large campus, there's thousands of employees there. If you wanted to get lunch, you couldn't go to the cafeteria anymore. You had to leave because there's, you know, they shut down the cafeteria to make room to hold people's tax returns. And literally, over 100 million paper tax returns were on backlog still in late 2021 from 2020 filed tax returns.
Gotcha.
So yeah, so because the IRS's budget being cut every year, year after year after year, anytime you have to interact with a person at the IRS is going to take a long time. Or even if you don't have to interact, if a person has to do anything with your return, it's going to take a long time.
I guess I was just thinking about how, like, with the different categories, if someone does put something else on a line item, or they jumble some, you know, two similar categories into one of the common ones, like, you're not really gonna give that a second thought, as long as it makes
Right,
sense.
especially if it's small numbers. There's an accounting concept called materiality or de minimis. Like if something's small, at least in proportion to everything else that's going on, then we don't really care if it's on the wrong line or something. If it's a large amount, if somebody says, I spent $120,000 on bookkeeping, and you're like, well, that's crazy because you only made $150,000. And they say, oh, actually, you know, that's supposed to be supplies or materials. And that makes more sense. You know, if that's, you know, you buy lumber materials for 120 and you sell your completed products for 150, that makes a lot more sense than paying your bookkeeper $120,000.
Gotcha.
The book is going to go through more details on what these specific categories mean, and actually the slides will too, but I don't want to go over all of that. So I'll just highlight a couple of these that are important. Okay, so here, car and truck expenses, so box 9, is business use of your vehicle, whether it's your personal vehicle or a vehicle that is specifically for business. And there are two ways to calculate that, and I will go ahead and present that slide when we get to it. But there's two ways to calculate that, and there is either, so for line 9, there is actual expenses or standard mileage. And actual expenses means whatever you spent on that vehicle, fuel, tires, maintenance, car washes, insurance, and I'm sure I'm leaving a bunch of stuff out, oil changes, and also depreciation of that vehicle would be part of your actual expenses. Your other choice is standard mileage, which in 2023 I believe is 63.5 cents. I'll look that up because I want to make sure that I have that right for next year. Oh, 65.5 cents. So the standard mileage rate it changes every year, and the IRS actually hires an accounting company to put out a survey or to survey the whole country and see what the average cost of operating a vehicle is nationwide. And so in 2023, this is 65.5 cents per mile.
Are people allowed to go, say they have 5 vehicles, and it makes more sense to count actual mileage, actual costs on certain vehicles and mileage on others? Are they able to hybrid like that?
Yeah, so if you have more than one vehicle, we'd actually have a separate worksheet for each vehicle. And you might say, well, my haul truck, you know, the truck that I use to carry lumber back and forth to my jobs, I'm gonna use actual expenses because it's a lot more expensive. It eats a lot of gas because I'm hauling a trailer along with it, and so I wanna use actual expenses for that. But for my sedan that I use to, you know, to do quick errands, I wanna take my 65.5 cents a mile because I have, you know, it's maybe it's more gas efficient. You're not hauling a bunch of goods in it. Maybe it's a smaller vehicle, so there's not much depreciation to take on it. So yes, you can mix and match.
And can you mix and match the same vehicle from year to year? Change it, or once you've committed to a certain version, then you've committed to that for the life of the vehicle?
You can switch back and forth from year to year, except that if you take actual expenses the first year, you're locked into taking actual expenses for that vehicle for as long as you own that vehicle. And the reason being that actual expenses includes depreciation, and when we talk about depreciation next week, we'll learn about bonus depreciation. So you take a lot of extra depreciation early on in the life of the vehicle. So if you take actual expenses the first year, you're locked into taking actual expenses for the rest of that vehicle's life. If you take the standard mileage the first year, you can switch back and forth freely however you want from year to year. So you could say, you could be taking standard mileage on your personal vehicle that you occasionally use for work, but maybe you had a major repair on it. So you spend $10,000 more than usual. You could take actual expenses that 1 year and then switch back to standard mileage in the future.
Yeah, that's what I was thinking. If you have like one of these scenarios where you overhaul the thing, and you want to be able to capture all that at that time,
Right.
where maybe you didn't have a lot of miles in that year, but you had a lot of repairs. So if someone Section 179's a vehicle, are they locked into actual?
Yes, because you can only take Section 179 or bonus depreciation the first year any equipment is placed in service. So that's where the first year rule comes in.
I see. Okay.
Okay.
So if you choose to depreciate it over a normal schedule, then you will with the miles. Okay.
Yeah, if you use standard, if you use standard mileage the first year, then you can switch back and forth. Right. You take actual expenses the first year.
That's what I mean. If you basically choose to depreciate something not over accelerated depreciation method, but under standard, say 5-year, whatever it might be. I guess so it's basically that as well as whether you take standard mileage the first year or not.
Right. Even if you don't take accelerated depreciation, you don't take bonus or 179, you still have when you take actual expenses the first year, you're still locked into actual expenses.
Gotcha. So that's kind of the rule that trumps the rest.
Yes.
Okay.
So it's all based on what you did the first year you have that vehicle in service. Okay. And I might as well mention it now since we're on the topic. You must keep track of your mileage, regardless of whether you're taking actual or standard mileage. It makes sense that you have to keep track of your mileage for standard mileage, but you still have to keep track of your mileage for actual expenses.
How frequently does someone have to, like a weekly kind of log or a monthly? Or?
Well, it depends.
It'd be
it's just for business, then you just write down the mileage at the beginning of the year.
Yeah, that's the only exception, of keeping a day-to-day mileage log. So every time you get in the vehicle, you write down what the odometer reading is right now, where you're going, what the purpose of your travel is, and when you're done, you write down the odometer reading at the end.
Seems pretty extreme or something. Is there ways that they can do that less, like once a week if they're basically going to the same places?
Well, you do that when you split your personal vehicle with business.
No.
No?
Well, I no to Dimitri's, but yes to you. You have to keep a contemporaneous log. So, like if you miss an entry, you could go back later that week and fix it up. But you should keep your mileage log as close to real time as possible.
Okay.
When I worked for the state, and I used a motor pool vehicle, I would have to write that stuff down. And they would audit their vehicle logs, fairly frequently. I don't know how often, but like if it turned out a vehicle was being used and it wasn't on their log, someone's getting in trouble. But even for your regular business, you have to keep your mileage log. And the only exception is if that vehicle is being used 100% for business. 100% for business is a pretty high threshold to meet, which means you never drive it home, you never drive it from home to work, unless your home is a business location. That's one reason when we get to home office deduction, you get that extra benefit besides just being able to deduct part of your home.
But stuff like my bucket truck and my dump truck that I'm not gonna drive to the grocery store, that's pretty obvious if it's
Right.
100% business.
You throw me in the package.
You don't take her along.
No. She does not talk to anybody in an authority
He
position.
brought me a thing.
Rules.
And if we're if it is something like that, in order to claim 100% vehicle usage, you basically have to have another vehicle that you use for personal use. So you can't say, so if I have, let's see, I have my Chevy out there, my car. I can't claim it as 100% business use because that's the only car I own.
Right, but if you showed up at my house, I've got 30 cars in my yard, so.
Right, you could claim that your bucket truck is 100% business use because you have a different vehicle that you're using for your personal errands. So that's one exception. Another exception to keeping a mileage log is if your vehicle is specifically, and there's actual specific rules for this, if it is not suitable for passenger use. So like a mail truck, like it only has one seat and you can't, so you can't like take your kids around it, at least not legally. You'd have to like tie them to the balls or something.
Bungee cords fits everything.
So that'd be things like where a vehicle that's had all of its seats ripped out, or and then certain emergency vehicles, things like that.
Okay. So if there are these exceptions that if it's reasonably complete business use vehicle, and you have a personal vehicle that you can claim as your personal vehicle, right?
Yeah.
Then in those instances, it's much easier to not have to be burdened by keeping all the mileage. If you basically have multiple business vehicles and you're switching between them for different purposes, to have to constantly be carrying a clipboard around and writing mileage down.
You should have a clipboard in each vehicle. But yeah, I have dealt with a lot more audits for this than any other line on your Schedule C. The IRS will say, show me your mileage log. If you don't have one, the IRS will throw this whole thing out.
Now, say like my bucket truck's 100% for business, I write down the mileage January 1st, and then December 31st, would that be a mileage log?
That could be, if you could reasonably say it's 100% for business use.
And if you've got 10 cars, then you can go take photos of odometers
Yeah.
for your whole fleet, day 1 and day 365.
Yeah, and the IRS, when they audit for mileage, for vehicle expenses, typically also ask for at least 2 service receipts that show the mileage on them.
What if you do all the service to your vehicles yourself?
Yeah,
Yeah, then,
it's more
Don't-
common here than
I
elsewhere.
would recommend, in that case, don't just write it down, but take a picture of your odometer.
Like on an invoice or work order
Yeah.
that like the shop would use?
Yeah, in some sort of verifiable way, so it's gonna, like if it has the meta image data that shows the date and time that the picture was taken, or hold the newspaper up to your, next to your odometer or something like that. So yeah, if you do all your own maintenance, then I would recommend,
If I do my maintenance, I would have a maintenance sheet usually, and I can just provide that to the IRS.
Yeah.
I did an oil change here. But like my bucket truck, the mileage isn't gonna match what it's actually used for though, because you run the truck to run the PTO, so it just sits there and runs, and the mileage doesn't click.
I think the solution for that is you basically separately line item equipment fuel.
yeah,
Which is kind of what we do, because we have like our equipment, which we, you go and buy it in bulk and then you fill up, 5 different pieces of equipment with that.
yeah, I think in the case of maybe your bucket truck, that might not even be a vehicle anymore. It might not fit the definition of vehicle, and that's something I would have to research.
It's a generator
Every-
with a drive axle and a steering wheel.
Telescopic hunting stand.
But yeah, that's how we kind of come to do it, because there's so many things where you just can't reasonably keep track of how much you're gonna use. And a lot of things that burn more hours than they do miles.
Yeah.
And so at that point, it's just equipment fuel.
Like the dump truck, that one, you just back at 30 seconds it dumps. That's not gonna be too far off the mileage.
But then you can't really capture your oil change very well on that either.
Right.
But yeah, the reason you have to keep your mileage log for, even if you have actual expenses, is because you're going to have a percentage. You're gonna, divide your business miles by your total miles, and you might come up with like 98 or 99%. But your actual expenses will be multiplied by that percentage. So, so that is important. And this is,
You're saying your tires and oil changes and stuff like that, based on that mileage,
based on that percentage of mileage, yeah.
that will get proportioned down as well.
Right, so if you spend $1,600 on tires during the year and you use your vehicle 90% for business, you get a $1,340 deduction,
Man, you're good at mental math.
$1,440. So, and this is another example. This is, so when we talked about charitable contributions, that was an example, and this is also an example of something called strict substantiation. And what this is, it's also called sometimes more colloquially anti-Cohen.
Andy Cohen?
Anti-Cohen. And this, so the history is way back in like the 70s. Singer-songwriter, somebody Cohen, I forget his first name, filed a business return and basically didn't have any of his receipts. Couldn't prove what he spent on his private jet and things like that. And these would be legitimate business expenses. He has to go to the venues that he's performing at. And the court said, well, IRS, you can't just zero it out. Obviously, he spent some money on his business. And so the court said that if the taxpayer can come up with a reasonable estimate of what their expenses were, and the IRS also comes up with a reasonable expense, somebody has to come up with a reasonable estimate of what the actual expenses were. And then subsequent to that, Congress passed these particular laws saying, well, for vehicle expenses, we're throwing out the Cohen rule. You must keep track of your vehicle expenses. specifically. Like your supplies and materials, like if you go buy 100 pounds of nails and you lose that receipt, well, you still know that you bought that. You can reasonably estimate how much that cost. But for vehicle expenses, you have to have the actual receipts in order to take any deduction. So I have seen the IRS. This is one thing I'll warn clients, like, we are willing to estimate this, try to figure out what your mileage is through a reconstruction process. But if the IRS wants to audit this line, they will throw it out.
So, owning a business, it's best to just take your car and have a company do the oil change, keep the receipt. Because you can use it as an expense, and then if they do audit you, at least you have proof.
Oh, yeah. Well, mostly the IRS is going to be interested in the mileage log. So, so if the IRS says, show me your mileage log, and you don't have one, you instantly lost this audit. And you'll get $0 car traffic expense.
And how in depth, like if you basically did the January 1st, or end of beginning of year, end of year, because it's all business vehicles, how in depth do you need to go? Do you like a description and miles, like year, make, and model, or do you have to actually have VIN numbers and a lot of detail for your records?
Well, the mileage log has to be traceable to the vehicle that you're using if you have multiples.
Okay.
If you only have one vehicle, then it's not that big a deal. And every mile that you claim for business travel has to have the date, destination, business purpose, starting odometer reading and ending odometer reading.
I guess I kind of asked from the standpoint of our business. We got some job sites, our home office,
Mm-hmm.
our shop, and we're basically just buzzing back and forth between these and like a store, like just like a pinball machine, back and forth to the same ones, same locations, but in different order, maybe certain days. Like, do you really have to go that in depth, or can you just list the locations that you went to that week or something like that?
You could probably get away with it if you listed the locations daily, but weekly would probably be too far.
Even if you're basically just visiting the same places over and over, back and forth?
Yes. I have had a client audited who was going back to the same place 6 days a week and had their business purpose and just said, oh, this was my weekly miles, and the IRS threw that out. And so we had them reconstructed on a daily basis, and they said, well, obviously you just divided your weekly stuff by 6, so we're still going to throw it out.
Okay.
So
I
yes,
guess-
your mileage log has to be detailed.
My challenge is my father's mid-60s.
Mhm.
He does the most driving, and he can't check the email, and he can't, comply with some of these things that we want, such like the miles. And so that's
Well,
why
it's-
I wondered,
I mean,
what is the bare
basi-
minimum you can do where it
The
can
bare
accommodate
minimum
people
is,
like that, that
well-
are stubborn and old?
well, what you could do for him, the bare minimum is, just like putting your seatbelt on, write down your odometer reading. Take your seatbelt off, write down your odometer reading. And then you could probably fill in the rest later. But if you have a daily trip record,
Because that's the other problem. Throughout one day, he might be in 4 different vehicles, right? And that's where it gets kind of tricky. Is he's not in the same vehicle all the time. He's always changing between different work vehicles for different purposes.
well, get a small clipboard and chain it to the console somehow. Like they sell these half-page clipboards if you can put a small book on.
Or a tape recorder, and just tell them to talk to each other and record it that way.
I guess it sounds like no matter what, we gotta make it even more strict somehow. Okay.
But yeah, I mean, if your mileage log is not that detailed, like day to day, at least, even if not trip by trip, but day to day at the very least, then you're risking the IRS eliminating your total deduction for that vehicle, or eliminating it down to what you did keep track of. So if you say, well, I'm gonna do it right this year, that's your New Year's resolution, and then by the time April comes around, you're like, I forget it, I missed it a couple of days, I'm not gonna keep up with it. Then the IRS will still let you deduct the miles you took that you wrote down. But, that's gonna be, still eliminate most of your deduction.
But like for him, in this case, he's pretty much just doing business miles and just doing business trips. Is it less of a concern in a scenario like that when he's not buzzing around in his personal vehicle?
But if you can show that the vehicle's 100% for business, you don't have to keep
Well,
such a
he doesn't have a personal life and he doesn't have personal destinations, and so from that standpoint, it's all business. I mean, it's primarily used for business as well. It's full of tools, you can't even sit in it. But that's what I wonder, like, what that bare minimum threshold that I can do for him.
I just need a little
Okay, so here's the exception. I'm reading this out of the Quick Finder. Okay, so to document business use, you have to have an account book, diary, or similar record, trip sheets, expense reports, and other corroborative evidence. So this is required, strict substantiation. You must have documentary evidence, including receipts, paid bills, and other information to be able to deduct your expenses. And the only time a mileage record is not required is for what they call qualified non-personal use vehicles. And that is delivery trucks that only have a seat for the driver. They may have a folding jump seat for maybe if you have a trainee or a co-pilot. Flatbed trucks, dump trucks, passenger buses with a capacity of at least 20, school buses, ambulances and hearses, tractors and other specialized farm vehicles. So you're not going to be driving your combine down the highway.
So it's a service body truck of some sort, flatbed, mechanic truck, or something of that nature, then it qualifies for non-substantiation?
Yeah, so you can avoid strict substantiation. Basically, these personal use vehicles is stuff that
could be used to drive to the store.
basically could not be used for personal use. That, let's see, we have clearly marked police, fire, and public safety officer vehicles, unmarked law enforcement vehicles that are officially authorized for use, moving vans, if personal use is limited by the employer, and any truck or van that has been specially modified so that it is not likely to be used more than minimally for personal uses.
So for us, we got,
So if you tear out your seats and install shelves, that would be the specifically modified.
so
vehicle.
in our case, we got like flatbed trucks or dump trucks or box trucks, right? And we have minimal in the way of like regular pickup trucks. His that he drives it is a pickup truck with a canopy,
Yeah.
full of tools and different stuff in the back, and it's around the seats, all the tool stuff.
Yeah,
That one sounds like may not be as easy to qualify,
that doesn't qualify as a non-personal use vehicle.
even if the only time it's ever available for a second person to sit in is when we clean it out once a year.
Because it was designed for personal use to begin with, so you have to prove that it wasn't.
But pretty much everything else, if it's like a 99% of the time, this is a strictly business type of vehicle, then those ones seem to qualify.
Yeah, you do have to keep track of your mileage on a daily basis. So, I'm not going to enforce that rule on you. Like if you tell me that you drove your vehicle 30,000 miles last year and it was 95% business use, if that sounds reasonable to me, then I'm going to go ahead and say, okay, well it's on you to have a mileage log, but I will go ahead and enter that. But if you don't have your mileage log, the IRS will throw out that deduction.
Right.
And so it's basically that's part of the training. So we, as tax preparers, train our clients. Like if you're not, and you can buy a little mileage log booklet at Walmart, and it's like $3 and $3.50, and it has all the required columns. But,
I get that, I'm just trying to understand how hard you have to push someone for them to understand, or how, for them to meet that bare minimum. Because for one, I mean, for your own stuff, it's probably easy enough to keep track of it or have a $100 book, but forcing other people to do it that don't want to comply, that's the bigger burden to kind of overcome.
How much do they want the deduction on their taxes?
yeah,
Is it worth buying a
or
$2
the
book?
business owner.
Right.
So, I mean, you might,
He's the business primary owner,
Right.
he's also the most stuck.
well,
So that's
well,
why-
just warn them, like, if you don't keep, I mean, best you can do is warn them and say, if you don't keep track of this, we're gonna have to pay an extra, potentially $20,000 in taxes.
What was that
You
we
don't want
talked about,
Substantiation of what?
no, when you have a partnership or something and you draft something for,
Operating agreement?
yeah, operating agreement, maybe you should write one of those up with your dad, that says he doesn't keep track of the mileage, he has to pay what the deduction would have been back to the business.
Yeah,
I'm sure doing some more incentive to start getting that.
yeah. Another option, if it was a partnership type business, could be that, partnership does not reimburse, or partnership does reimburse, for personal use of your vehicle, or for business use of your personal vehicle. But if you do reimburse, then you would need a report saying, this is my mileage. We used to, when we had, people, delivering flyers all over town for this business, we would give, the person who was driving, a mileage log and say, if you keep track of your miles, we'll pay you for that, and that's a deduction on our end, and it's non-taxable on your end because because it's a reimbursement and not a pay. So that's one way to do it, is write them a check for turning in a mileage log once a month or once a week. So then now you have a monetary incentive. I mean, he's the owner, so it's kind of hard to do that, but
Yeah.
if you have employees that are lax on their business miles, then if they're using a company vehicle, then you could say, I mean, there is some precedent for if you can't prove that you use this vehicle for business purposes, then that's personal use, and that's going in your W-2, and that's taxable income to you. And that's one of the fringe benefits that could end up on your W-2.
Yeah. It's all easier when they have a W-2 and stuff like that to kind of incentivize with, for sure.
But yeah, that's, I mean, if people are stubborn, I mean, you can only do what you can do, but just keep in mind, you're risking that deduction completely. Okay, a couple other ones that I'll highlight. Let's see, depletion we almost never see, so I'll highlight that in red. Depletion would be if you are mining your land for oil, gas, gravel, or even timber, there would be a depletion deduction.
How would that work if, say, somebody had a piece of land that's like a gravel yard, right? That they're depleting the resources out of it, and it's, say, $1 million gravel yard. Do they just depreciate that land, based on?
Depletion deduction is actually fairly generous, and it's just a percentage of the gross revenue that produced by that resource. Oil and gas is 15%, gravel is less, I forget how much less, I think it's 7%, but don't quote me on that. So if you sold $1 million of gravel out of your gravel pit, you have a $70,000 deduction. And that reduces the basis of your land, that's your depletion deduction.
Oh, so when you go to sell it later,
Yeah.
because usually you can't reduce or depreciate land. In this case, it's an exception to that rule,
Right, it's not depreciated, it's depleted.
and
So,
it just reduces your basis like that, similar to the way depreciation works.
And the reason I call it generous is because you get to keep taking that depletion deduction even after your basis is reduced to zero. So if you bought if you bought 50 acres in Texas somewhere for maybe it cost you $100,000, you got some cheap land, and then somebody discovers oil on your land and produces $5 million worth of oil out of that, you get whatever 15% of that is, you get a $750,000 deduction, and that was worth more than what you paid for the land. You get to keep taking that deduction, and your basis will go down to zero, but it'll stop. It can't go negative, but you get to keep taking that deduction. Okay, depreciation I'll highlight. That'll be its own chapter. Depreciation in section 179 deduction. Employee benefit programs, this is pretty rare, but this is,
Like 401ks and stuff.
yeah. And this is not the owner's 401k. That's,
So in a partnership, that wouldn't work.
yeah. Right. This is specifically and only for employees where you would deduct that. For the owner, you would deduct it if you had your own 401k. For the owner, there's a different line you would deduct that on somewhere in Schedule 1.
No. With a partnership, if you started a 401k or 401k for one partner, you'd have to do it for all three, right?
Yes.
Okay.
Yeah. There are testing rules and non-discrimination rules for 401ks.
But you could also still make it a high threshold if you've got employees that come on and they're just seasonal, you don't wanna give them all the benefits that you get if you've been there for 5 years.
Right.
Right, you can make like a high threshold to getting certain profit sharing and other stuff.
Right. I mean, you could say, you could put in your 401k that you have to work for us for at least 3 years before you get any retirement benefits.
So if at that time you're being especially generous with your other partners in terms of retirement contributions, and everyone else has only been there for half a year or a year,
Right.
then you can be generous 1 year, right, and then be less generous in future years potentially?
I don't know all the details of a 401k, but I do know there's testing for non-discrimination. So basically, you can exclude some part-time employees, but if you have a 401k for the owners, you have to have the same or similar 401k for all the employees as well.
Full-time employees.
Interesting.
Then there's this line for insurance, that is any kind of general business insurance, that would be liability, business, accident and fire coverage. That specifically excludes health insurance, that does not go on that line. If you pay for your employees' health insurance, that would be an employee benefit and would go on this other line.
How about automotive type insurances?
And vehicle insurance would go under vehicle expenses. So here, you do include workers' compensation, because that's not a health benefit, that's something else.
But for a partnership, you don't need workman's comp because it doesn't cover the owners, right?
Right,
But you might still have
Yes.
workers' comp for employees.
yeah,
Yeah.
yeah, so this would be, so your liability coverage, your general business coverage, your, if you own buildings, your building,
Property
casualty coverage, and workers' compensation insurance are the normal things that go in there. I also generally include bonding expenses in there, because even though it's not technically insurance, it's usually underwritten by an insurance company. So I put that in there. And then there are two lines for interest. One is for mortgage interest, so this would be real estate that you own for business purposes. So not your home, but if you owned a warehouse that was on a separate lot, then the mortgage on that would be mortgage interest.
But not for like a rental property.
Right, well you can't, yeah, you wouldn't have interest on a rental property. And then other interest, this would include, any other interest other than a mortgage. So that also includes vehicle interest, and I should mention, going back to vehicle expenses, actual expenses you get to add on, even if you're taking actual expenses, you can include additionally parking and interest. Or, I mean, sorry, that should have gone down here with standard mileage. Standard mileage, you can include parking and interest and add that onto your standard mileage. So 65.5 cents per mile, but you know, if you bought your vehicle and you still have a loan on it, you can deduct the interest as well, in addition to the 65.5 cents. Interest would also be any business loans that you took out, but it would be any interest on any money that you borrowed with a business purpose. So if you took out home equity line of credit to help, you know, produce the startup funds for your business, we talked about itemized deductions. You can't deduct that as an itemized deduction because it wasn't used to buy, build, or improve your home, but you can deduct it as a business expense if you use that money for business purposes. And if you have a credit card that you're using mostly for business, then you can deduct the interest on the credit card also. I mean, technically if you use it at all for business, then you can deduct some of your interest, the business related interest portion of the interest on your credit card.
How about things like if you got a credit card, it ends up being in your name, but it's primarily for the business, is the whole point of getting it.
Mm-hmm.
You can, like, things like the annual fee, you can generally expense out no problem on the business end.
Yeah, yeah. I often recommend to people who have trouble keeping records that, you know, if you're eligible for a credit card, get another credit card. And it doesn't have to be a business credit card, but get another credit card that you only use for business purposes. Writing Sharpie on this is my business card.
Just to be able to separate them.
Just to be able to separate them, because then you, a lot of credit card companies will give you an annual breakdown. This is how much you spent at Napa, or not Napa, but at car repair places. And this is how much you spent at grocery stores. This is how much you spent at restaurants. This is how much you spent on airfare. They categorize it for you. And that makes, if you don't want to hire a bookkeeper and you don't want to pay us to do your bookkeeping, then that's one good way to do it. Legal and professional fees is specifically, let me just double check this. I believe this is actually pretty narrow, so let me double check here.
Yeah, I've got a question on that one. Just for us, like engineering and land surveying and things like that, I was gonna know whether it goes into that category or under like, projects and like.
Legal and professional services include fees for tax advice and tax preparation, as well as legal fees relating to business matters.
Yeah. Legal and professional is typically,
Sounds like it's 80% legal.
yeah. Legal and accounting is what we normally put in there. But I think any professional is someone who has to have a license and is authorized by the profession that they're in. So I think if you were to hire an engineer to draft plans, I think that would also count as a legal or professional fee.
Yeah, 'cause engineering and land surveying
Mm-hmm.
ends up being a big one.
Yeah.
With every project, but you never quite know where to put it in terms of how to account for it properly.
Yeah. So I would put surveying and engineering costs in here as well.
And that one that fits closely enough where you can throw it in there without having to put it on part 5?
Right.
Okay.
Because surveyors and engineers are professions. So I would put that in there. And yeah, Daniel mentioned that tax preparation is also included in here. But tax preparation has to be business related to be deductible. So if I'm doing your tax return, it's got a 1040, which is your basic tax return that everybody does, and a Schedule C. And if those are the only two forms that are related to your tax return, you can only deduct the Schedule C part. So maybe maybe my invoice says 1040, $100, Schedule C, $250, total $350, then you can deduct the $250.
Is that one of the major reasons you guys do it that way, so that people can break that part out of the rest when they go to expense that the next year?
Yeah, well, we charge by the form for a lot of other reasons than that, but yeah. We also, when our invoices come out, they add up every little thing, and sometimes we'll give a discount off of that. Like maybe I spent 45 minutes on your return, but all the little different forms that are produced, maybe it says, oh, your bill is $1,725. I say, well, I'm just going to charge you $300. But then to figure out what your deduction is next year, I would have to go to that full invoice and then, prorate it, like, because you can't ever deduct 100% of your 1040 tax preparation, because part of it is for the personal part, your child tax credit and your basic tax return and earned income credit. Those are not business related, so you can't deduct that part of your tax return. Okay, then office expenses are things like ink, paper, printers, stuff that basically any business needs to use to do their paperwork.
Things like
Computers.
picnic cheap tables and
Yeah,
chairs
this
and
would be an
stuff.
this would be an office expense.
Things that are not of a value enough to put it into your furniture category, right?
Right.
Or whatever it's called, fixed assets or something.
Office expenses also would include things like postage. Business cards could really go in either category, could go in your office expenses or advertising. And then like promotional items, like the pins we give away that have our address on them, that would be more like advertising, because we're not actually using it in our office. Okay, I'll wait for Daniel to get back. So this part is, line 19 is for pension and profit sharing plans. And so I made a little bit of a mistake when I said 401ks would go on this line 14. That's 401ks and stuff like that would go on line 19. 14 would be any other employee benefits, like if you purchase health insurance for your employees, that would be an employee benefit plan. And pension and profit sharing plans, again, do not include any of the owner's 401ks or anything like that. And here for employee benefit programs, you would not include any part of the owner's health insurance costs.
So you would not include owner's health insurance costs?
Right.
Did you say?
Right. Owner's health insurance and owner's pension, like, or profit share 401k, go on Schedule 1.
Why wouldn't they just go on here with?
Because all of these expenses are reducing your net profit, which is reducing your self-employment tax. And the 401ks that you put on your own behalf is still taxable, or if you put money for 401k, or if they have deferred compensation, that is still taxable for Social Security and Medicare purposes, even if it's not taxable for income tax purposes. So your self-employment taxes, so it's not deducted here because you still have to pay self-employment tax on whatever money you've set aside for your own retirement.
I see. And the reason it works for employees is because they're already, it's all jumbled into the W-2 anyway already.
It's all part of the business.
Right. Yeah, and it's part of your, it's expenses that you're paying.
When it comes to the owner, they don't consider the owner and his healthcare and stuff part of the business expense. That's all considered private, right?
Mm-hmm. Oh, really?
So you have all your business expense, and then whatever the owner or the partners of the business do for their retirement and whatnot gets taxed to them instead of through the business, correct?
Well, it's right. It ends up on their personal part of the return because you still get a deduction for it for income tax purposes, but it's not deductible for self-employment tax purposes.
So if I had a business and it was just me and I wanted to get my teeth fixed, and I spent $5,000 through the business as a health dental benefit for myself through the business, I wouldn't be able to still take the standard deduction to capture that. I'd have to itemize
If
it.
you spent $5,000 on your own medical expenses, that's not a deduction at all for business. That would go on your Schedule A as a medical expense deduction. If you had dental insurance that covered part of that or most of it, the insurance would be deductible as self-employed health insurance on Schedule 1, but it would not be deductible for self-employment tax purposes.
Okay.
So any owners, because you're still getting a benefit, so it's still a profit to you, you're still getting a benefit out of it. Because when you're self-employed, you're not your own employee. So you can't deduct any employee benefits on this form,
But if you were
because you're not an employee.
But if you were an S corp, then you potentially could.
Yeah. Yeah, because you would, in that case, you are an employee. But it wouldn't affect your employment tax because S corps don't pay self-employment tax because there's no self-employment. Okay, then there's a line for rent or lease, and it's separated between vehicles, machinery, and equipment, and anything else. So vehicles, machinery, equipment, pretty obvious, and then anything else is pretty obvious. So if you're renting a warehouse, or if you're renting a post office box, that would be under this other business property.
If you had heavy equipment that, you have maintenance and upkeep and repairs and all fuel and all kinds of stuff you would need for that, it would not go in that category because it's not renting or leasing, it's simply.
It would go on the next line for repairs and maintenance.
Okay, so that repairs and maintenance is not like, it's a broad term where it could be equipment or it could be
Right.
buildings or
Yes,
whatever.
repairs and maintenance could be anything. Yeah. And then supplies, it specifically says not included in part 3. Some supplies are more like materials, so anything that is included in your cost of goods sold would be anything that is included with what you're selling. So if you were selling furniture, you might have lumber and wood glue and varnish or epoxy or something in here, and nails. It was part of your cost of goods sold. But then you would have other supplies like cleaning supplies for your shop. Taxes and licenses. Remember, sales tax is normally deducted off the top instead of down here, but then you have your business licenses, you might have occupational taxes, and that would those kind of things would go in here. You might have a bed tax, and then that would also be included in here. If you were like a hotel or something like that. Travel and deductible meals, should,
They call it a bed tax, but does it go by, you know, if it goes by unit, room, or actually like number of beds?
it's a percentage of what you charge. And it's, it's called a bed tax, but its technical term is usually a transient accommodations tax. Travel and meals we'll talk about separately as it comes up later on in this presentation, probably on Monday, because we're getting close to 8. But travel and meals are again, so just like car and truck expenses, which I'll put a star by. This one I'll also put a star by. These are also strict substantiation items.
Yeah, my sister's really strict on travel and food.
Travel is any business travel that you do that is appropriate and helpful for your business. So if you're in, we have some real estate agents and they go to their annual conference, it's always in Las Vegas. That travel is actually deductible because that conference is, helps them network and learn tools and tricks and tips for their business. So that travel is deductible. Or if you travel to some other location, so normally be outside, technically outside of your general work, it's called your tax home, is the general vicinity of where you earn most of your money. So, so if you do most of your work and business in Wasilla is your tax home, even if you live elsewhere. So if you are commuting from Big Lake and doing your work here, Wasilla is your tax home. Anytime you're away from your tax home for business purposes, that would be considered travel.
So if I had to go to Alexander Creek on a boat or a plane to cut down someone's tree, I could use that as a travel expense.
Mm-hmm.
And then if I went to Vegas for like an what is it called?
Arborists.
Yeah, that thing, convention. That me and the partners could all fly down there and use that as a tax.
Yeah.
Travel expense.
Yeah. So your strict substantiation for travel would be where you traveled, what your business purpose was, and some samples of who you met there and how you expect that to improve your business. So if, let's say when we had an office in Kauai, traveling to that office to hire and make sure the office is still there and our equipment is all still there, that would be business travel. If you got a contract from someone in, let's say in Valdez, they said, oh, we have a bunch of trees we need taken down, and you fly down there, that would be business travel.
I would drive a logging truck down there for that one, but yeah.
When you travel, is pretty much all of your transportation and meals when you are way outside of your tax zone, is that all considered business?
No.
It would be considered business as long as there was no significant element of recreation or personal use in that travel.
I guess my brother and I, for purposes of sourcing stuff, we've gone on business reasons to China and India. But a lot of those expenses are cash that they're not taking a card. You basically have to be able to pay cash, and you don't always get a receipt. But in those cases, can you take the standard daily rate for a location?
For meals, yes, you can take a standard meal allowance for meals. For everything else, no. So your airfare, your hotel and lodging, if you rent a vehicle.
I know the GSA has a standard that they issued based on different areas. And if you go off of that, then you don't have to necessarily record keep, you can kind of just go off of the days.
Yeah, for purposes of meals, you would keep track of just the number of days.
Okay.
But for everything else, you keep track of your actual expenses. So that could either be through receipts, or if you're paying cash for everything, and you don't get receipts, keep a journal instead.
A journal, so you can always know what you started with and what you came back with or something like that.
No. You would keep a journal, you would write down every time you paid cash for something and didn't get a receipt.
Okay. But would you, if it was for, I guess, you're saying transportation is separate? So it's
Yeah.
your lodging, because I thought the GSA allowance, it covers lodging, per diem, lodging and meals combo.
The GSA does, but not for tax purposes. What the GSA publishes, well, GSA is for the continental United States, it's Department of Defense for Alaska, Hawaii, and outside the United States.
So yeah, I think they have it for other countries and
Yeah,
cities.
DOD does that for foreign countries. So even though you can find it through the GSA website. But what their lodging rate is the maximum amount the government will reimburse you for government-related travel.
But if you're basically traveling for your own business,
Right. That number is completely, totally irrelevant.
at that point, it's just up to you and your own record keeping.
Right. So if you look up, if you're traveling to Vegas and you look up on the GSA website and they say $149 a day for lodging, that number is meaningless. There's no standard lodging allowance.
Okay.
It's only the meals that's useful. 'Cause
So if you travel somewhere for business and you pack yourself a cooler of sandwiches, you can technically take the standard meal allowance
Right.
every day and eat the sandwiches you brought that you packed a week ago, and you would be okay with that
Yes,
from a tax standpoint.
yes. So the standard meal allowance is actually fairly high in my experience. I don't know that anybody actually spends the full amount of the standard meal allowance. So the per diem, it's called per diem also. That per diem rate is, for meals, is fairly generous.
So I have a question. So this year, I spent half my year outside of my tax home, in being in Seattle and like Michigan for work. You know, one of them I was there for like a month and a half. I was, you know, staying with friends, working on our equipment and stuff like that. How does that work? Can I just take my per diem there? And I don't have to substantiate it really in any way?
You don't have to substantiate, your meals if you're taking a standard meal.
And would that be for the business or would that be personally?
That would be for the business, because,
Okay.
well, are you an employee?
Partner.
You're a partner. So it could be either way, depending on your operating agreement.
Okay. And so when I went to Seattle multiple times for work as well, and can I the same do that?
Yeah.
And okay. And if multiple of us flew down to deal with, you know, like bringing equipment up, then all of us can each take a per diem for our meals, even if, say, half our meals was spent at, you know, relatives' homes and stuff like that.
Yes.
We can still take a per diem.
Yeah.
Okay, so as long as you can figure out the dates that we were gone. And
Yeah.
the thing.
Yeah. So when I have clients that travel for business purposes, they usually will have receipts. They'll have their hotel receipt, their airfare receipt, their car rental. And I should mention that rental cars, instead of putting them in a car and truck, I put them as travel expenses. So their rental car, the fuel they put in their rental car, they'll have all those receipts, and then they'll have a bunch of receipts for money they spend at restaurants or for groceries. I usually set those aside and ignore them because the standard meal allowance is so much higher than what reasonable people actually spend on meals.
Oh.
It's,
So in this case, when I was in China and I was in India, could I take a standard meal allowance for those areas?
yes.
And where would is that the GSA or the DOD or how it's?
That would be the
local?
DOD. So
Okay.
DOD sets rates for OCONUS, which stands for outside the continental United States, and so I would look up OCONUS per diem. And if I was doing,
Because I feel like this is one of those things where people know the automotive like mileage rate and its importance, and sometimes it's more valuable than keeping track of expenses. But for meals, I feel like most people don't know that, especially if they travel semi-frequently. But
so I know that there's a lot of stuff on the screen, but this is, so what city were you at closest to?
Which country are you in?
This is China.
Let's just go with Shanghai, for example.
Okay, Shanghai. So there's 3 columns, lodging, meals, and incidental that are highlighted. So maximum lodging is completely irrelevant. There's no such thing as a lodging allowance. So in fact,
Unless you're actually part of the DOD.
right.
Okay.
Unless you're actually working for the government. Well, you don't have to be part of the DOD. You could be part of the State Department or.
But you're basically there on a government trip, essentially.
Yes. Right. This is what the maximum that the U.S. government would reimburse you if you're traveling on their behalf. But it has nothing to do with taxes. So in fact, when I print these out, because Alaska is part of this, Alaska is outside of the continental United States. So when we print these out, we just black that whole column out, because that number is completely irrelevant, has nothing to do with your taxes. But we do add local meals and plus incidentals.
You get them both?
Yeah, this is your standard meal allowances, those 2 numbers, $138 a day.
Wow.
So if you spent,
Per person.
yeah, so if you spent 1 week in Shanghai, then that would be 137 times technically 6.5, because one of the other rules for a standard meal allowance is your travel days count as 3/4 of a day. So the day you arrive is 3/4 of a day, the day you leave is 3/4 of a day. So if you're there for a whole week, that's 5 full days and 2 travel days, 6.5 total.
So when we went to China, we basically started on one end and we traveled across the multiple places. Sometimes we spent like a whole day nearly traveling.
Mhm.
How does that count? Because it's still
Count
part of the
where did
business
you
trip.
spend the night every night, and you would have to look this up for each night. So I have,
Is that the kind of thing where you do the best given the information you have simply? You count it up?
yeah, no, well, I mean, I would ask you, where were you each night? Where did you stop?
Well, I guess I'd have to basically follow that and timeline to figure it out. But
Yeah, and that's this kind of work we'd have to do.
right,
to-
but I mean, you wouldn't look at like I was here for less than half a day or more, or if you were. I mean,
No, it's where did you spend the night is where it's gonna be based on.
Okay.
So instead of looking at China,
I mean, if we guys look at Seattle, or I guess the Seattle metro area.
well, I'm just gonna look at Alaska,
Okay.
because, in the continental United States, there's basically only 2 numbers, it's either 69 or 89. And it depends on whether it's a high cost of living area or not. Those numbers change each year, so it might be a different number in 2022 or 2023. But in Alaska, because this is set by the Department of Defense, it's a different number for each vicinity in Alaska. And I do quite a few tax returns for in-state truckers, and so then, and some railroad workers. And so I have to, I will actually print out a calendar and say, well, I'll go through they'll have a stack of, their records, because this is stuff you have to keep track of when you're a long-haul trucker. And it'll say, okay, on January 3rd, you were in Fairbanks, January 4th, you're in Fairbanks, January 5th, you're in Fairbanks, January 6th, you were in Tote, January 7th, you're in Anchorage, but that's your tax home, you don't get a deduction. You live in Wasilla, but your tax home is Anchorage, because that's where you start and end your trips. And then you took a day off, and then January 9th, you were in Talkeetna. January 10th, you'd gone back and you went to Tok. I would do this and I'd add up the number of days for each location and multiply it by whatever number is on this chart.
So you just basically make an Excel sheet, chart of the places that you frequent, and you kind of count it up from there?
Yeah.
Okay.
Actually, I find it easier in this particular case not to use an Excel sheet, but I would use something like,
You count the total number of days, and you have, for each major location, you just add, let the sheet multiply it for you?
no, what I actually use is something like this, where I would put
It's like something that somebody fills out, and then it's all color-coded for you or something?
not 35, 53 is what is this?
For people who live in Wasilla, and they don't go to Anchorage often, but if they have to end up going to Anchorage and they basically spend the whole day there for work, do they get a per diem of some sort for working there the whole day?
I'm sorry, say again?
If someone does a trip into Anchorage, they live in Wasilla, and 95% of the time they're always here. If they end up going to Anchorage, to essentially run errands, and they're doing work there all day, and they come back to Wasilla at night, do they get any kind of per diem for the
No.
whole day that they spend in Anchorage?
No.
Okay.
Don't you only get per diem if it's nights spent away?
Yeah. One of the rules for per diem, for taking the per diem allowance, is your trip has to last long enough that you have to sleep at night. So if you got up at 8 in the morning and you were there till 8 p.m. and came back home, there's no per diem.
So my instance where went to Michigan for like a month and a half, and it probably took me 2 days to get there between all the layovers and everything like that.
No per diem for that.
Do you get a per diem for at least one of those
Yeah.
days, or wherever the layover location was, and you bought your airplane food there, and how does that work?
Yeah. So
Wouldn't
if
that be
you
a
were
travel allowance?
Hmm?
Wouldn't that be a travel allowance?
the standard meal allowance, so yes, you would deduct that for wherever you spent the night. So if you were trying to fly to Florida and you spent the night in Dallas, you'd get standard meal allowance for Dallas for that one night, and then Miami for the rest.
And if your tax home is Wasilla, and you catch a red eye, and you basically get to Anchorage at like 9 or 10 o'clock, and your flight's somewhere at like 1 in the morning or whatever, right? And you basically spent your night in Anchorage, and then you get to somewhere in the morning, and then you got layovers farther from there. Do you
Then
get
you
it?
would count the day in Anchorage,
You
yes.
would? Okay.
And basically your standard meal allowance is based on wherever you spent the night, where you slept.
Okay. So all of the red eye nights essentially count wherever the airport's at. Good to know.
So here would be, this is an example, this is a calendar. I would actually print this out and write down a 3-letter abbreviation for every location they're in. So I might write down Fairbanks, Healy, Anchorage, and then I just skip the Anchorages. And then I'd highlight them in different colors, the boxes I highlight.
So when I was in Michigan, I was like an hour and a half away from Detroit, a rural area. In a scenario like that, would I need to find like the closest city based on like a zip code, or how would that work, or do I just go like would I just click Detroit effectively at that point, because that's the closest major town? I guess I don't know how specific to go.
Maya, get all your crayons, put back in the
outside
bag, get ready to
continental
go.
United States, for Alaska, Hawaii, and foreign countries, it would go with wherever they were nearest to. For GSA, so if you were in say Washington. Skip past the lodging rates and go to meals and incidental. There would be all other locations not listed. So unless you're going to one of these specific locations, you would use the amount for all other locations not listed.
And so the Seattle metro area, you know, if you're basically all over it, I mean, does it basically go based off of where you sleep there?
Mm-hmm.
But you might be spending most of your day in Seattle, but sleeping in Tacoma, for example. In a scenario like that, would you go with Seattle or Tacoma? If it's basically your meal allowance.
It would be wherever you spent the night.
So even if you sleep in an area that's cheaper, but you're eating your meals in an area that's more, and all your time is spent in an area that's more.
It's wherever you spent the night.
Off your night.
You should have got your meals to go. Get up in the morning, take it with you.
And then you still get your incidentals on those, only at $5.
Yeah. So meals and incidentals, $69 Tacoma, $79 in Seattle. I guess there's more than just two rates now. And $59 for any other location. So rural Washington would be mostly $59.
If I'm essentially on the edge of Tacoma in Federal Way, because all these cities kind of merge into each other, and Tacoma is, you know, a certain, kind of like Wasilla. Wasilla is technically bigger than the city limits. Would that be justifiable just to go with Tacoma in that case if it's,
Probably, yeah.
if they merge into each other?
Yeah.
Okay.
So, like, yeah, probably the suburbs would probably be fine to count those Tacoma. Yeah, so that's one type of meals, and that's also still strict substantiation. You have to be able to prove that you were there. And your other travel expenses, airfare, hotel, lodging, strict substantiation. You have to be able to detail why did you go there, how it was beneficial to your business, who did you meet with.
So if we went on a 2-week trip that was mostly business, and we had like a wedding for 1 or 2 days somewhere,
You would prorate that out.
you would simply not count those days.
Right. So
But
if
you
you,
would count the rest.
Mhm.
Okay.
So, and we do have, sometimes we've had traveling nurses where we do their taxes, and they say, well, you know, on my way back from Texas, I stopped by to visit my friend in Oregon for a week. Then you would say, well, that week doesn't count for your standard meal allowance, and then that leg of airfare doesn't count.
Do travel nurses get a meal allowance for every day they're not in their original home while they're on a 3-month hitch somewhere? They get the standard allowance even though they might be in PB&Js?
Yep.
Oh, wow.
So you'd have to figure out where their tax home was. And one of the rules that changed in 2018 was employees don't get any business deductions, period. So if they were self-employed as a traveling nurse, then, which is rare, but it would go on here.
Because I know that they probably get it per diem paid.
Yeah.
But if you get it per diem paid, then you probably can't deduct it.
Right. Right. If you're reimbursed for your business expenses, you can't deduct them.
But
But it's not taxable income if it's a strict reimbursement. But from now on, well, at least until 2025, if you're an employee, you don't get a business deduction anyway. Period. And so this, Tax Cuts and Jobs Act actually screwed over a lot of people like traveling nurses and employee truckers. And actually one person I know that was an engineer who rented his own office space. He's an employee, no deduction. You don't get to deduct the $20,000 a year for your office space.
But the traveling nurse example, they would potentially still be able to,
If
they're
they're
an employee,
self-employed, they would get to deduct it. If they're an employee, no deduction. Employees do not get business deductions.
so if they're a traveling nurse gets paid via 1099, they're fine.
Yeah.
If they're a traveling nurse that gets paid via W-2, then they can't.
Right.
Okay.
Yeah, the only way around that is to get reimbursed for that, and then you wouldn't be taxed on your reimbursements. And you might actually, prefer to negotiate lower pay in exchange for having these non-taxable reimbursements. Like you'd rather get paid $40 an hour and get reimbursed for your expenses on a non-taxable basis than get paid $50 an hour and have to pay for your own expenses without being reimbursed.
So they say 40 plus per diem,
Yeah.
and then all that per diem is non-taxable effectively.
Right.
Can you pay yourself per diem as an owner?
No. When you are a Schedule C sole proprietor, you, or even a single member LLC, you and your business are totally married. There is no difference between you and your business. So if you pay for your business expenses with your business card or your personal card or with cash out of your pocket, it doesn't matter where that money came from. It's all you.
Same with a partnership?
It's different with a partnership because it has to be, if it's paid for by the partnership, then every partner shares equally in the deduction or proportionally in the deduction. Let's see, so that was travel and meals, but there's also a second type of meals that are deductible, and that's business meals that don't involve travel. And that's still strict substantiation, and there's no standard meal allowance for that. So if you are going to a meal with a client, for example, and there was some business purpose for your meal, then that's a deductible meal. That one does have strict substantiation requirements. Best practice is to just write directly on the receipt who you were met with and what you discussed.
In a scenario of ours where we've got job sites or wherever we're working, and sometimes like just to get more done that day, my mom might buy pizzas and bring us pizza so we don't have to all leave and kind of disrupt the whole day and try and come back. That's really for the business reason of getting those meals. Is that generally deductible?
Generally not deductible, because you would have to eat anyway.
But if you're basically working through your lunch effectively,
not deductible.
it's not
Period. It's only deductible if you are providing food to your employees as an incentive to keep them at work.
What if that's what we're doing?
Then yes,
Okay.
but they have to be your employees, not independent contractors.
What
And
if
they can't be the partners.
if it's all partners and you're all there together?
If you don't have the employees, there's no way to deduct it.
Okay.
That's for business meals?
For business meals provided on your job site, only deductible if it's provided to your employees as an incentive to keep them at work. And I think this might have changed, but at the time I learned this rule, you also have to be a corporation.
What if it's general refreshments that you stock the workplace?
That would be more like office expenses, like the soda and stuff. And the candy and stuff. That's all deductible.
Okay.
But if when Rhonda orders pizza for the office, that's deductible because we're all employees, herself included, because we're organized as a corporation. But if you pick up a bunch of people who are going to the job site and you say, let's stop by Taco Bell on the way, not deductible.
I thought it was basically for a business purpose, a business location potentially, and made for basically everyone that's there in order to get more work done. It'd be, I guess, I thought that was essentially the bar, but it sounds like it's more strict than that.
It's very strict, yeah. So meals to be deductible, other than travel meals, have to be with some sort of business contact, like a supplier, or so I guess maybe you could, under that rule, deduct meals with your contractors, contract laborers, but probably
basically getting meals, there so you can stay on the job site, cause someone's supposed to show up that you have to meet, and you can't really leave, cause it's kind of dependent upon when the client or the contractor show up, you're basically making yourself there available, so you can't just go take off for lunch for an hour. Is that enough reason?
No, travel, meals and entertainment is, I believe, its own chapter, so we can talk more about that later.
Okay.
Are we gonna be able to fit all of book 2 in 2 weeks?
Hopefully, I'll try to do my best. Yeah, chapter 17 is all about business travel, meals and qualified business income. So those, yeah, the meals are very strict. And the last thing before I let you go, I'll say about meals is, except for specifically tax years 2020 and 2021, only 50% of your meals are deductible. I mean, not 2020, 2021 and 2022 are the 2 years where you can deduct 100% of your meals. For meals taken in any other year, 50% is deductible.
No, are those meals, do they have to be at a restaurant with a receipt, or?
No, they can be meals that you picked up at the grocery store. Except 80% if you're subject to Department of Transportation restrictions, which means basically truckers. So if you are limited to hours per day limitations imposed by the Department of Transportation, you can deduct 80% of your meals.
Is it also because they probably can't drive into their favorite barbecue place in the middle of town with their semi?
Right.
And so they gotta grab a meal wherever they want, or wherever
Well,
they can get to.
Yeah, so that's going to include truck drivers, airline workers, some maritime workers. You're not allowed to drive a truck more than 12 hours a day. I think it's 12 hours. So because of that restriction, you have to stop, and they'll let you take 80% of your meals.
Because you don't have as much choice on where you're eating.
Yeah, and your mileage log, if you're a truck driver, your mileage log is not daily, it's an hourly mileage log. And it will say, like, this is when I stopped for the day, was 7:30 p.m. Because that can be audited not by the IRS, but by the Department of Transportation. If you're in violation, you and your employer can face pretty hefty fines.
Right.
Or if you get into an accident and they find out you're driving your 16th hour, then you lost your job. Okay, we'll see you Monday.